The producer price index for July of 2025 went up 0.9%, which is an annual rate of almost 11%. That is a very high rate of inflation. This brings up the relationship between inflation, interest rates, and bonds. So inflation is defined as the overall increase in retail prices over time. It's also defined as too many dollars chasing too few goods. That's how we define inflation. We're already seeing it at the grocery store. Food prices are way up. Electronics, IT products were way up in price, which led to this big increase. So what does the Federal Reserve do to combat inflation? Well, what they do is they raise interest rates, which slows the economy, slows things down. Hopefully fewer people are buying goods as the economy slows and inflation gets under control. But there's a trade-off, because bond investors are really harmed when this happens, when the Federal Reserve raises interest rates. And here's why. A bond investor, let's say you buy a $5,000 bond for 10 years at 6%. If interest rates are going up, bonds of similar quality, new bonds that are being issued for 5 years, are being issued at higher interest rates, which means that your 6% bond is less valuable. So it's harder to get bond investors to buy bonds as interest rates increase, because the coupon rate they're earning is less and less attractive. If you're at 6% and now they're being sold at 6.5% and then 7% and 7.5%, the price of your bond at 6% will fall because it's simply less attractive. So what we're seeing also in the Treasury market is the 10-year Treasury, which is a good measuring stick for what's going on in interest rates as a whole and what the market thinks. The 10-year Treasury rate, the bond price is going down and the interest rate is going up, again, because people are anticipating more inflation, the Fed increases interest rates, and bond investors who are holding bonds at certain interest rates are going to be worse off because those interest rates they're earning are going to be less attractive. So that is a relationship between inflation, bonds, bond investing, and interest rates.